Hello traders, Steve Ganz here with another in the Compare and Contrast series. And the one today is going to be somewhat simple. A little bit of a spoiler alert. There's not going to be much difference between these two types of positions. One of them is a bear call spread. The other is a bear put spread. Now note, in both of these situations, we have a bearish tilt, hence the name bear on these. So in other words, we're expecting with this position, we're expecting the market to go down, or in the way we've positioned this, the market doesn't even necessarily have to go down. It just can't really go up much. Now we could have positioned these differently to where they did need to go down, but we're currently the at the money here is right around this 439. So in both of these trades, if the market stays in this 440 range or lower, both of these trades will become profitable trades. Now, these are both expiring on July 21st. And so they're 32 days out. So everything's the same on these. I put the implied volatility at the same. And we'll see that if we look at these two trades, this one, and again, in this one, what we've done is we have sold a 440 call, which is essentially an at-the-money call, and then we've bought a 450 call for insurance that protects us. So if the market were to rip up, we wouldn't have an unlimited loss. So we've sold this 440, which is almost at the money. Which means that we're probably getting about top dollar for that, because the at-the-money option strikes tend to carry the highest value and the most what we call extrinsic value, which is the amount of value that we want to drop out of this option if we're selling it. So we're going to sell a 440 call, buy a 450 call in this situation. And we're going to take in $460 in credit to do that. We have a maximum potential loss of 539 on this trade, chance of profit of 63%. Our break even is at 444. Right now, this trade's showing an unrealized loss of about $3. That, of course, is because of our commissions and or the bid-ask spread difference right at this time. Now, we look at that, essentially the counterpart, if you will, to this trade, the other way you can do this trade with puts. And in this case, we bought the 450 put, and we are selling the 440 put. Okay, so I'm trying to put these at the same strikes so that we can compare apples to apples here. And in this case, we're paying money for this. Now, this is where it does get a little bit weird. Is, well, one of these we're taking in a credit, one of these we're paying money for it. Don't let that throw you. It's really a non-issue. It's all about looking at the P&L diagram and how these things are going to decay over time. Now, this one is showing a slightly larger max loss to it. I wouldn't let that throw you. It's also showing right now that it's down $22. All that's telling me is that there's a wider bid-ask spread in here somewhere. Now, we are after hours right now, so this particular is 553 to 556, so that's not it there. There it is right there. So 1105 to 1145. So that's a 40-cent bid-ask spread. That won't be there when the markets are open. So this will also then at that point show about a $3 open loss. And again, that's just the difference in the bid-ask spread in this case. So we're looking at essentially the same break-even amount. So pretty much all the stats between these two, if we look at them, are going to be largely the same. Theta is very, very similar. Delta is pretty close. Now, delta is how beneficial the position is, or how skewed. Maybe skewed isn't the right word to use because we use skewed in other places. I guess it's the rate that the position is going to go in your favor if the market goes down. So if the market goes down, this one is going to go in our favor a little bit faster than this one is. So those are just a couple of the things we can look at. Again, nothing significantly different between these two positions. So the next thing I'd like to do, since we see that they're very, very similar here in the shape and how they will act, let's go ahead and move the two of these in time. So this is going to be, if we take this back to today, this is what these two positions are going to look like. Again, they're going to look very, very similar in nature, very similar P&L diagrams. If we were to go to, let's just say 436, here we're up about $87. If we go to 436 here, we're up $95. So again, we're kind of splitting hairs here. There's not going to be a big difference one way or the other. Now, volatility right now is quite low. Let's see if volatility were to change. I don't know that volatility would get much lower than this. Could get a little lower, but not much lower. But volatility could potentially get higher, particularly if we get a pullback. So let's just say that volatility goes up to, and this would be an extreme move. 25 is not an extreme number, but it would be an extreme move from 14s or 13. So, but let's just put it up there just for the heck of it, to see how these two might react in a volatility spike. So in a volatility spike, we can see if we come down here to 436 that this particular one is going to, at that point, be down about $67. And over here, we're going to be down a little bit more. So this is one of the nice things we can do with modeling software like optionstrat, is we can see these two positions that look really, really similar in nature. How might they differ when volatility shifts or at different points in time in the future? Now that's it. This is if volatility were to drop immediately today. Let's come out further, or to a point in time. Let's come out to, I don't know, let me pick June 13th, right at the start of the day maybe, or the end of the day on June 12th. And let's move this one to June 12th, end of day as well. And let's see, we're at 5:10, June 12th. Well, let's go in there. Yeah, that's 5 o'clock, 5:10. That's pretty darn close. I'm not too worried about that. So again, we can look at 436. So at the 436, if the market pulls back to 436, this is going to be at $34. Call it $35. Here, if the market pulls back to 436, we're going to be at $93. Okay. So that's one of the things that you can look at, is two positions that happen to look almost exactly the same when you put them on will be impacted differently by volatility. And really what's going to happen here is that the put that we are short is going to increase in value significantly. So that's what's going to kind of work against this, is this short put that we have to buy back. Now this one is going to increase in value too, but because this one was at the money when we sold it, it's going to most likely have a higher level of increase to it. So those are the things that we need to, kind of play out, for lack of a better term, is don't just look at how the position looks when, when you put it on, but also take a look and see how that position acts when volatility spikes. And one of the ways that you can tell this is Vega. Vega is a measure of how this is going to be impacted when volatility spikes up. We can see this position has less Vega associated with it, which means that it's not going to be impacted as badly, as negatively against us in a volatility spike as this one that has a Vega of 18. So that's really the main difference between these two, is we need to take a look at the volatility. So let me just reset all of this back to 0, or back to current conditions. And I want both of these again to be the same, even though there will be a little bit of a difference probably between those two. and come out to expiration on these. And again, we can see our Vega reading here is really the big difference between these two positions. So the same is going to be true, although I will demonstrate that as well. I'll demonstrate the bull call, bull put spread will be our next one in our series. But again, the goal here is in a compare and contrast. These two positions are going to look virtually the same, regardless of the fact that, again, one of them we take in a credit for, but this credit is going to decay in our favor, where the other one is going to essentially go up in value. We're going to pay for this one, but it's going to increase in value over time if the market decays here or does what we want it to do. So again, at the end of the day, both of them will provide us profitability at approximately the same rate. They will both show loss at approximately the same points if the market were to rip up against us. So the big difference between these two really boils down to, in this case, how they act if there were to be a volatility shift. So the takeaway here is anytime there are two positions that essentially look the same, make sure you at least go in and take a look and see how they're going to act in different market type conditions, specifically volatility being one of the biggest ones that people need to factor in. So hopefully this comparison of the bear call spread, bear put spread, gives you a good idea that at the end of the day, not a huge difference here. If volatility is low and you are expecting a potential volatility increase with your pullback, this might be the better option for you by a slight amount. If volatility is already high and you're thinking volatility might end up dropping over time, which usually doesn't happen with a pullback in the market, but maybe this one could have a slightly better edge for you. But at the end of the day, these two are going to play out very, very similar in nature unless there is a huge volatility shift along the way. So hopefully that all makes sense. I know it gets a little confusing here when the positions are that much similar. But thank you everyone for your time, and we will see you next week. Take care.